Hello and welcome to this video. So in this video, we're covering MAC4862 Test 3 2021. So I'm just going to start reading the scenario and then we will answer the question as we go along. So they say Stay Safe Pty Ltd SS is a protective gear manufacturer established in 2007 and operates a manufacturing plant in Soweto, Johannesburg. SS manufactures protective gear mainly for the healthcare industry, which includes reusable masks and shields. The company makes use of an absorption costing system, and all its inventory items are valued using the first in, first out method. The company has a May financial year end. Okay, so just like some important things that you know, they operate a manufacturing plant, which you see in Soweto. They manufacture they manufacture protective gear, okay, for the healthcare industry. And so let's take note here. So this question is going to have masks and shields, but these are not the only products that they provide. Okay, so just like to get at least some kind of picture in your head. But what's the most important thing over here in this paragraph is that they use an absorption costing system. So when a company uses an absorption costing system, what must go through your mind? You must tell yourself, when you see absorption costing system, you must tell yourself that the cost of a product includes three things. It includes direct material, direct labor, and manufacturing overheads. Now, the question is which manufacturing overheads, because there are two types. There is variable manufacturing overheads and there is fixed manufacturing overheads. So when you're using the absorption costing system, it will include both fixed and variable. Okay, so just always run that through your head, that the cost of a product includes three things: direct material, direct labor, manufacturing overheads. In this case, it's going to include both manufacturing overheads, variable and fixed, because we are using the absorption costing system. Okay, the next thing is just that we have a financial year end of May. Okay, so let's read masks. So they say the manufacturing process of reusable face masks starts with a fabric input of raw materials consisting of cloth and straps. Fabric input is fed into a mask manufacturing machine. The cloth is then rolled, nose strips welded, and cut into appropriate sizes by direct laborers. Thereafter, the masks are tested for effectiveness and sterilized to prevent contamination during storage. Finally, finished masks are packaged and sold in boxes which contain 20 masks each. Okay, so that paragraph is just taking you through the process of manufacture. Okay, so you want to kind of visualize what's actually happening. So you can kind of see there's like three parts, like where raw material is input, then there is the laborers part, and then there's a packaging part. Okay, so in the laborers part, there are a few steps involved, but basically there are three parts to this whole process. So you can just want to kind of picture what's happening. We all know how our masks look. So we can kind of picture, if we're reading this process, how it gets made. Okay, but for me, one of the most important aspects in this paragraph is the last sentence. So that they're telling us that masks are packaged and sold in boxes which contain 20 masks. Why this is important, so you must keep note on how the question is going to test. Whether they're asking us for one mask or whether they're asking us for a box of masks. Okay, so you must now, we'll have to keep our head up straight to see what is a product. What is one unit of a product? Okay, is one unit of a product one mask, or is one unit of a product a box of masks? So that's very, very important in management accounting. Okay, so now let's say the general manager of SS has provided you with an extract of the actual information for the month of May 2021. He has also highlighted that fields described as outstanding in the table below still needs to be determined. Okay, so let's have a look. Okay, so we can see there is sales, and there's note 1.1, sales commission, opening inventory, closing inventory, then there's fabric input, opening inventory, purchased inventory, and closing inventory. So what you must understand over here, so this over here is the completed, the finished product. This over here is the raw material. Okay, so take note of those type of stuff. And then we have direct labor, distribution costs, and manufacturing overheads. So note number, is read the notes. So they say, SS sells the masks to both the public and retailers at 1,000 Rand per box. Okay, so more or less indicate that a unit of product is a box. Okay, the price has not been revised since April 2020, and sales occur evenly throughout the year. The sales team earn a 10% commission on the total sales value they sell. A long-term agreement was reached with a raw material supplier to supply the fabric input, cloth and straps, used to manufacture masks at 1,200 Rand per meter. A material loss equal to 5% of the fabric input occurred during the manufacturing. All raw material losses are sold as scrap at 16 Rand per meter. There are no opening or closing work in progress for May 2021. A box of masks requires 30 minutes of direct labor to manufacture. SS provides a free delivery service to all of its clients. Delivery cost relates to transporting of boxed masks. Manufacturing overhead costs are allocated based on number of boxes manufactured. SS budgeted to manufacture and sell 8,000 boxes at a total manufacturing overhead cost of 800,000 Rand for the month of May 2021. The actual completed and transferred masks was 7,900 during the month of May 2021. As I just read that, I'll go in detail through those notes as we work through the question. So I'm going to stop there and we're going to do the first question relating to this. But there's just something I want to bring to your attention when it comes to management accounting. When it comes to management accounting, you'll generally see something of this nature. So there's three things we're going to pick up when we're dealing with for each section in management accounting, right? In a question paper. So generally three things they'll tell you. Whether the information is actual or budgeted, the date, so in this case, May 2021, and then the period, okay? So is it a month? Is it a year? Is it by 6 months or something of that nature? So always take note of that. How is information given? Actual or budget? The period, which is 1 month, 1 year, or whatever it is, 1 quarter, and then the date. Okay, so we know this is actual information for the month of May 2021. Why this is important? When you read the required, that will help you to direct where to go look for information relating to the required. Okay, so what I'm going to do, I'm going to read part A. So here's 5 questions in this paper: A, B, C, D, and E. I'm going to do A. I'm not going to do B. B you can read through yourself. It's just a basic theory. Okay, actually theory, just common sense that you need to apply regarding masks. Okay, then I'll do part C. I won't do E is an auditing question, and I may do E. Okay, because E is some calculations when it comes to E. Okay, so here is part A. Part A says calculate the actual closing inventory value of for mask boxes as at 31 May 2021. Motivate each item you exclude from your calculation. You may ignore the fixed overhead over in recovery, communication skills, and okay, so we must motivate for each item we exclude, and we can ignore fixed overhead over or under recovery. Okay, so they say calculate the actual closing inventory value for mask boxes as at 31 May 2021. Okay, so here you can see closing inventory for mask boxes. Quantity and amount is outstanding. So what do they want? They want this number. Okay, so let's go into this, and then I will explain how you go about answering a question of this nature. Well, so basically, the thought process is the same for whichever subject you're dealing with, whether it's tax, whether it's accounting, whether it is management accounting. Start with the end in mind. So the process is start with the end in mind and then work yourself backwards. So for example, in this question, if you must look at the solution, you will see they don't start with the end in mind, they end with the end in mind. Well, that's okay for them. They set the question paper, they know what they are looking for, right? So for us, we are answering the question. We didn't set it, we're answering the question. So what do? We start with the end in mind. What is it that they want? What do they want? They want closing inventory balance, okay? So the question you need to ask yourself is, how do we determine closing inventory balance? It's the same thing if you are doing in accounting, for example, if I ask you to prepare the balance sheet, first ask yourself, how do the balance sheet look? How the balance sheet look, and then slot in the various items. Then you go start and getting the numbers. So same thing over here. Start with the end product. What is the end product? The closing balance of inventory. So how do we calculate the closing balance of inventory? Basically, so particularly in management accounting, it's going to be made up of two things: quantity, so number of units times price per unit. So number of units times cost per unit. So that is basically what we are wanting. Now we say, okay, what of those do we have? And what are those we don't have? So the ones we do have, we slot it immediately. The ones we do not have, we obviously will have to calculate it. And then you move again down. Then you go to the same thing. If you don't have quantity, how do we calculate quantity? And that's how you go step by step, and you will be able to figure out what is given and what you don't have, and calculate all the missing pieces. Okay, so the thought process is important. So what's a thought process? Start with the end product, start with the end in mind. What do we want? We want closing inventory. So how do we calculate closing inventory? Number of units times cost per unit. Okay, so I'm going to switch over into Google Sheets, and then we're going to go through this. Okay, so you should see Google Sheets in front of you. So we're going to do A. Okay, so this is question A. Okay, so for required A, they're asking us, what are they asking us? What are they asking us? Trying to think now. Oh, closing inventory. So closing inventory equals, so closing inventory equals number of units on hand. So number of units on hand, closing number of units times cost per unit. Okay, so that is basically what we want. So I'm just going to put it over here, number of closing units, and then cost per unit. So what do we know? We know we don't have any of those numbers. Okay, so we don't have the cost per unit, and we don't have the closing units. So that means we'll have to work it out. Okay, so this will give us closing inventory balance. Okay. Okay, so I just took this and I rearranged it like that to help me easily calculate using Google Sheets. Okay, so let's have a look. So now I'm going to do my workings. Okay, so I'm going to start calculating closing units. You can calculate any number you want because we know either none of these we have. So we have to calculate both of it. So I'm just going to start with closing units. So the way you calculate units, when you want to calculate closing units, when you're dealing with inventory, okay, what you want to use a cost of sales formula. The cost of sales formula says cost of sales equals opening inventory plus purchases or production. So in our case, we'll call it production because we manufacture. We call it purchases when you're a retailer, where you buy finished goods. But if you manufacture goods, we call it production minus closing balance. Now we want closing balance, so that means these three items needs to be given to us, or we must be able to calculate it somehow. Okay, so rearranging the formula, closing balance equal opening balance plus production minus cost of sales. Cost of sales is basically the items that are sold. So let's rearrange it into a spreadsheet format. So opening balance, production, cost of sales, and that will give us closing balance. So I know that is how I would calculate it. Now we go look if any of these numbers are provided. Okay, so opening balance, opening inventory, production is production or purchases, and then this is cost of sales, just basically the items you have sold. Okay, so let me switch back into the question. Okay, so the question here we have, okay, so opening inventory, opening masks, opening inventory. So remember, it's very important to understand which inventory balance we're busy with. We are busy with finished goods. So we're not going to use this information, that is raw material. We're going to use information relating to the completed product. Okay, so opening balance, 1,200 Rand. Okay, so opening balance, 1,200 boxes. So if we go back to, so opening balance, 1,200 boxes. Now we need production. Remember in the question they told us actual production was 7,900 boxes. So actual production, the actual completed and transferred boxes of masks was 7,900, okay, during the month of May. So if we go back, so production, 7,900. Okay, so 1,200, that is opening balance. Production given to us, 7,900. Okay. Now, we need the sales value. How many units were sold? What do we know? We know that this is the sales value, and we know each box is 1,000 Rand. So that must tell us how many units we must have sold. So that means we can simply say 4,500 divided by 1,000 Rand per box, and that will tell us how many units were sold. 4,500, 1, 2, 3, divided by 1,000. So we must have sold 4,500 units. So now we can work out what is on hand. So on hand is that amount over there. So we have 4,600 units on hand. This is a minus because the formula says closing balance is opening balance plus production minus sales. Okay, so there we said opening balance is positive, production is positive, and then we say minus the amount of units that were sold. So the closing balance units is 4,600. Now remember, I use this for units, but you can also use this in Rand value. So remember, if you're looking for any of these numbers in Rand value or in units, you use that formula. Okay, we couldn't use the Rand value to calculate closing balance because we don't have these numbers in Rand value. We don't have the other numbers in Rand value. Okay, so that is why we use it for units. In most cases, you're going to use it for units, but you can also use it for Rand value. Okay. Okay, so now we can work out the cost per unit. Okay, so now we can work out the cost per unit. Okay, so when we work out the cost per unit, this is where the thinking of what is a cost of a product? What is the cost of a product? What does the cost of a product include? So remember, the cost of a product includes three things. So production cost of a product includes three things: direct material, direct labor, and manufacturing overheads. For manufacturing overheads, which manufacturing overheads? Because we're using the absorption costing system, it will be both manufacturing overheads, variable and fixed. Now, I don't think we have variable manufacturing overheads in this question, but if they were, then you would include it. Okay, so let's have a look. So let's go working two. So for working two, we need the cost of a product. Okay, so we need the cost per unit. To get the cost per unit, work out total cost of a product and then divide it by the number of units manufactured. Okay, so here we're going to have, let's say, details amount. Okay, so we're going to have direct material, so it's fabric input. This is direct material. Okay, then we're going to have direct labor. Then we're going to have variable manufacturing overheads, and we're going to have fixed manufacturing overheads. When we read the scenario, there was no variable manufacturing overheads. I'm just including it just for you to see how we go about calculating. So remember, when they ask you for a cost of a product, always tell yourself a cost of a product includes three things: direct material, direct labor, manufacturing overheads. Then you stop and you ask yourself, which manufacturing overheads? So that depends on the costing system. So because we're using the absorption costing system, it is both manufacturing overheads, variable and fixed. If it was a direct costing system, it would only be variable. Okay, so just take note of that. Okay, so this will be total cost of production. This will be total cost of production. Okay, and then we're going to say units manufactured or units produced. And then this will be cost per unit. Okay, so let's have a look. So there may be more things we include over here. But those are the common things, okay? And then as we read the scenario, if there's anything else, we can just insert. So let's have a look. Let's go back to the scenario. So now we need direct material. So this is the direct material. Okay, they're not giving us they're not giving us. They're just telling us it's 1,200 Rand per meter. So we still need to work out the number of meters used. Okay, so 1.3. Okay, so here we go. So we dealt with this part. They say the sales team earn a 10% commission on the total sales value. Remember, anything we don't include, we need to make mention. Okay, so anything we don't include, we need to make mention of. That's what they told us. Okay, so what we're going to do over here, we're going to say, going to insert here a few lines. So we're going to say items excluded. So we're going to say sales commission not included in the cost of the product. It is a selling cost and not a product cost. There's a 1.2 we excluded, okay? And we're telling them why we excluded it. Okay, then they say a long-term agreement was reached with a raw material supplier to supply the fabric input used to manufacture masks at 1,200 Rand per meter. A material loss equal to 5% of the fabric input occurred during manufacturing. All raw material losses are sold as scrap at 16 Rand per meter. There was no opening or closing inventory. There were no opening or closing work in progress inventory for May 2021. Okay, so we can use 1.3 to work out how many meters were used in production. So once again, we have opening inventory, we have closing inventory, and we have purchased inventory. Okay, so you see why I call it purchase, because we don't manufacture the fabric, we buy the fabric. Okay, so what do we need? We need basically the fabric that was transferred to work in progress. So that is basically the inventory that was used in the production of in manufacturing. Okay, so remember, if you think about standard costing, when we deal with raw materials, there are two types we deal with: raw materials purchased and raw materials used. Okay, so just think about that. So the raw materials used is the one that goes to work in progress. That is the one we want, because that is what is the raw materials are used is the one that is that forms part of the cost of inventory. So let's go back. So that means we're going to have to work out raw material. So we apply the same formula as cost of sales. Okay, so working 3. So we need the cost of sales amount. So remember, cost of sales equals opening balance plus purchases minus closing balance. Okay, so basically the cost of sales amount is the raw materials used. So opening balance and then purchases. So this is raw materials purchased then it's going to be minus closing balance, and that will give us raw materials used. Okay, so cost, I'm calling it, it's not called cost of sales, just using cost of sales formula. The cost of sales is basically the sold part. Now remember, the raw materials, we're not selling raw materials. The sold part of raw materials is the raw material that is transferred to work in progress. So this is, I'm just saying cost of sales, so you can see the follow the formula, but basically it is raw materials used. Okay, so that is what we want. So we know the opening was, I can't remember. So it was 900, 2011. So 900, 2000 and minus 1100. So now we can work out what is the raw materials used. Okay, so we used 1,800 raw materials. Now remember they told us that there was a 5% loss. Okay, so this amount is including the loss. Okay, so remember so what was actually transferred was 100%. Okay, so this is 100%. Okay, so this is what was transferred to work in progress. This is before the loss occurred. So this is all the raw materials that were transferred to work in progress. Once we put in the 1,800 meters, then 5% is lost. So this is not after the 5% is lost. This is before the 5% is lost. So just think about it as follows. You're going to the storeroom, you go fetch the raw material. So you're fetching 1,800 to plug it into the system, into the work in progress system, into the machine. So only once it goes into the machine, then the 5% loss takes place. Okay, so this is before the 5% loss takes place. Now we know costs per meter. Okay, so remember there's 1,800 meters. So the cost per meter is 1,200. So that will give us cost of direct material used. Cost of direct material used. So it's going to be 1,800 times 1,200. Okay, so we go over here, we plug it in. It is whatever that amount is. Okay, so there we go. So this here is working 3. Okay, now we can deal with direct labor. Now we can deal with direct labor. So they told you a box of masks require 30 minutes of direct labor to manufacture. So each box is half an hour and labor cost is 80 Rand per hour. Okay, so this is a quick calculation. So I'll just do a separate calculation. There's no need to do a separate calculation, but I just do it. So direct labor, it will be labor hours per box and then labor rate per hour. Okay, this will give us labor costs. Okay, and we're going to need the number of boxes. Insert row, undo. Okay, wait, we just undo that again. Okay, so labor costs per box. Okay, then we're going to say number of boxes, and that will give us labor costs. Okay, so you don't need to go this long way. I'm just going the long way so that you can, what am I doing? So that you can see the thought process. Okay, so hours per box equal 30 divided by 60. There's 30 minutes, but we want it in hours. Okay, rate per hour, 80 Rand. So therefore, labor cost per hour is 0.5 times that, so it's 40 Rand. Number of boxes produced, 7,900. Remember, we're dealing with actual, so therefore we use a 7,900. So it's 40 times 7,900. Okay, so 316,000 Rand. Now we have a look. So we dealt with 1.1, we dealt with 1.2, we said we excluded it. We dealt with 1.3, we must all deal with the loss, okay? We must all deal with this material loss. I'll deal with it just now. And then we dealt with 1.4, then with 1.6, it is a delivery cost, but this is delivery cost to all clients, okay? So delivery cost relating to transporting of box masks. So that is a selling cost, so we don't include it. Okay, so we go over here and we will say delivery cost to clients not included. Same reason. It is a selling cost and not a product cost. Okay. So that's why it's excluded. Okay. So now we must deal with 1.6. Okay, so 1.6 it is, so there's no variable manufacturing overhead, you can see. So now we must deal with fixed manufacturing overheads. So so there's no variable manufacturing overhead, so we can plug in 0. So this here is working for, we need working 5. So manufacturing overheads, actual fixed manufacturing overheads is calculated as follows. So working 5, actual fixed manufacturing overheads is calculated as follows. Fixed manufacturing overheads equals absorption rate multiplied by, okay, so actual fixed manufacturing overheads applied equal absorption rate or overhead rate. So absorption rate, overhead rate, same thing, predetermined overhead rate. So absorption rate, fixed overhead rate, predetermined overhead rate, same thing. So absorption rate times actual activity. Okay. So what we can do, what we need absorption rate, we need actual activity, and then that will give us fixed overheads applied. Okay, very important. So what is applied is based on actual activity, using the absorption rate, but using actual activity. So actual activity, or the term activity, refers to how is overhead, what is overheads based on? Okay, how do we allocate overheads? What do we base overheads on? So 1.6 tells us manufacturing overheads are allocated based on number of boxes manufactured. Okay, so therefore actual activity is based on units produced. Okay, so remember, overheads can be allocated based on labor costs, or labor hours, or machine hours, or material costs, or units produced. Okay, so there's different ways overheads can be allocated when we use the traditional costing method. So remember, you have the ABC method and the traditional costing method. We're always using the traditional costing method unless they specifically tell you to use ABC. Okay, so when we use the traditional costing method, there's always one basis of allocating overheads. Like I said, either machine hours or labor costs or material costs or units produced. They told us overheads allocated based on manufacturing. What did they say? Overheads allocated based on number of boxes manufactured. Okay, so basically number of boxes manufactured, that is units produced. Okay, so that's very important. So actual units produced is 7,900. Okay, so we know that. Now we need absorption rate. The way we calculate absorption rate is as follows. So once again, I'm going a long route just so you can see how things are done. But basically, I'll explain to you now how you could have done this quicker. Okay, so I'm just going the longer route, like detailed calculations to help you think. Okay, so absorption rate or fixed overhead rate or predetermined overhead rate equals budgeted costs divided by budgeted activity. So the absorption rate is based on budgeted information. When we want to work overhead applied, we take budgeted information times actual activity. So absorption rate, budgeted costs. Okay, so let's put this in budgeted costs, budgeted activity. And it'll give us absorption rate. Once again, the word activity, how is overheads allocated? Okay, so we know it's based on number of boxes manufactured, units produced. So they say SS budgeted to manufacture and sell 8,000 boxes. Okay, so now we know budget activity 8,000. What do we also know? And at a total manufacturing overhead cost of 800,000 Rand for the month of May. So this here is 800, 1, 2, 3. Okay, so then we go that divided by that, which is 100 Rand. So the total overheads applied is equal to 100 times 7,900. So as you can see, the overheads applied does not equal 800,000 Rand. It equals less than 800,000 Rand. And why does that make sense? Because we only produced 7,900. We produced less than what was budgeted for. However, if let's say we actually produce 8,100, let's just say we actually produced 8,100, you can see fixed overheads applied would have been 810,000 Rand. We wouldn't be able to apply 810,000 Rand. We'd have to limit it to the actual budgeted cost of 800,000 Rand. Okay, so just take note of that. Okay, so there's just one more thing we need to deal with, and that is the, so what I wanted to say quickly. So that this calculation could simply be like this: 800,000, 1, 2, 3, divided by 8,000 times 7,900. So you don't have to go through the long thing I did over here. And then same with labor costs, could have just been 30 divided by 60 times 80 times 7,900. Okay, you could have just done that, and then you get the same answer. So you don't have to go through this whole calculation over here. But I just wanted to show you the thought process. Okay, so there's one more thing we need to add in, that is the lost units. Okay, so scrap value on lost material. So what do we know over here? There was 1,800 meters that was put into the process, multiplied by 5% of the 1,800 that was lost. So 1,800 times 5%, that gives you the number of meters that were lost. And they told us we sell it for 16 Rand per meter. If we go to 1.3, so here they're telling us all raw material losses are sold as scrap at 16 Rand per meter. The material loss equal to 5% of the fabric input occurred during manufacturing. So fabric input was 1,800. Of that, 5% is loss, and then we sell it for 16 Rand. So we're making money, so we can say, so it reduces the cost of production. So it'll be 1,800 times 5% times 16 Rand. So total costs equals the sum of these. The number of units produced was 7,900. So therefore, cost per unit, it is that divided by 7,900, which is 413.24. So now we can go plug that in, working 2 equals 41324. Okay, so we'll say 4,600 times 41324, and that is the closing inventory balance. My answer may slightly differ to the solution. That is because of Excel or Google Sheets. So when we plug it in, so for example, I'll say 4,600. If I type in 41324, you will see we get a different answer. Okay, so you can see that is 904, that is 883. The reason being is I plugged in the numbers, so it only say 4,600 times 41324. But this one is running all into the decimals till wherever. So that is why there'll be a rounding difference. Okay, so don't stress about that. So that is basically part A. I'm going to ignore part B, because part B, you will see over here. If we go through part B, so part B, discuss how COVID will impact the future pricing of masks manufactured by SS, taking into consideration the supply and demand. Okay, you can think through that. You can read through all of these information over here. I'm not going to go through that. It is not cost accounting specific. Okay, so it is just general knowledge that you can apply by reading through that over there. So I'll do part C. Okay, so part C says, we first need to read the scenario. Calculate the budgeted margin of safety for visors for the year ended 31 May 2021. Calculate the margin of safety percentage for visors for the year ended 31 May 2022. Now, when you want to calculate margin of safety, once again, you start with the end in mind. What is the end? The end in mind is what? The end in mind is how do you calculate margin of safety? So we first write down the formula, and then we start plugging in what we have and calculate what we don't have. But before we get there, let's read shield department. We must deal with visors. Here is visors. Okay, so you can see visors under the shields department. So it says SS also manufactures and sells 2 types of shields: medical eye shields and face shields. So medical eye shield is goggles, face shields is visors. The main material for goggles and visors is a plastic resin called polycarbonate. SS buys polycarbonate from an external supplier and tests it for quality before feeding it into the manufacturing machine. Each manufacturing kilogram of polycarbonate results in a 2% normal wastage of material input, which can be melted at 8 Rand per kilogram and sold as recycled sheets at 200 Rand per kilogram. Each goggle weighs 300 grams and each visor 100 grams. The shields are sold in boxes of either 200 goggles or 200 visors. Once again, so a unit is to a box of 200. So here they're telling us the general manager provided you with the following budgeted information for the next financial year ending 31 May 2022. So here we have budget information for the year 2022. Okay, so very important. Okay, so they're giving us the various information: budgeted units manufactured, total units budgeted to be sold, selling price, raw materials, variable overheads, variable selling and admin, fixed manufacturing overheads, fixed selling and admin. Okay, so let's have a look. I will go back into Google Sheets. So we're going to do required C. Okay, so required C. So with required C, we want margin of safety. Okay, so margin of safety equals budgeted sales minus break even sales or I'll do like that, budgeted units, budgeted sale units divided by break-even units divided by budgeted sale units. Okay, so we say budgeted sale units break even units, and that is going to give us margin of safety. Margin of safety percentage. Okay, so there we go. So we need to get that information. Now we have a look, what do we have? So we need break-even units, and we're going to need margin of safety percentage. Okay, so budgeted total units budgeted to be sold 180. Okay, so we can plug that in. Budgeted units to be sold 180, 1, 2, 3. Okay, so this here is given. Now we're going to have to calculate break-even units. Now what's important for break-even, okay, so we'll come to that now. Okay, so we'll deal with break-even units. So let's have a look. Working one. Okay, so you can say workings. So now we need break-even units. So we start off with writing down the formula. So break-even units equals fixed costs divided by contribution margin per unit. Now remember, third year as well as CTA, we don't anymore deal with contribution margin. Okay, we deal with a weighted contribution margin, and what confirms that is that we have two products. When we have more than one product, if you have one product, we use contribution margin. When we have more than one product, we use a weighted contribution margin. Okay, so now we need to work out all of those items. So that means we're going to need fixed costs. We're going to need weighted contribution margin per unit, and then that's going to give us break-even units. Break-even units. Okay, so that's going to give us our break-even units. So let's go and work it out. Okay, this is going to be a percentage. I'll change the percentage when we get there. So let's work out the fixed costs. As you can see, we start with the end in mind. Then as we see what is missing, we start calculating. Okay, that's how you can work systematically and you won't get confused or jumbled up with what needs to be done. So fixed costs in the scenario, we have fixed manufacturing overheads and we have fixed selling and admin costs. Okay, this will be, so this here will be fixed manufacturing overhead. This will be fixed selling and admin costs, and then that will give us total fixed costs. That will give us total fixed costs. Okay, so they gave it to us 35306, and then 669, 600. So 699, 600, 500, 603. Let me just check again. 306, 500, 306, 69, 600. Okay, so we add that up. Okay, so fixed costs working 2 is the sum of those two numbers. Okay, now we need to work out. The weighted contribution margin per unit. Okay, let's check quickly. 35306, 699, 600. Okay. Now to do weighted contribution margin per unit, it's going to be as follows. So working 3. We will have details. Then we're going to have goggles. Then we're going to have goggles, not Googles, goggles and visors. Here we have a total column. Okay, so what we're going to need, so for weighted contribution, we're going to need contribution margin. So therefore, we're going to have sales minus all variable costs. So let's have a look. It's going to be raw material, variable overhead, variable selling costs. Okay, so raw material, variable manufacturing overheads, variable admin, variable selling and admin. Okay, let's just see if there's anything else. So we don't want fixed costs, don't want that. Okay, so that's about it. Okay, so now let's have a look. So the selling price, 125 and 100. Okay, so 125 and 100. So this will be contribution margin per unit. Contribution margin per unit. Okay, so raw materials, it is 48.30 and 52. 48.30 and 52 minus 48.30 minus 52. Okay, next we have variable overheads, which is 12.40 and 14.50. 12.40 and 14.50. 12.40 and 14.50. Okay, and then lastly we have 220 and 250. 220 and 250. Okay, so we add this up. Okay, so we just have a look. Numbers 52. Okay. That is the contribution margin per unit. But we don't want contribution margin per unit. We want a weighted contribution margin per unit. So the way we get that is by adding in a sales mix. And then this will give us weighted contribution margin per unit. Weighted contribution margin per unit. Okay, so this answer over here is what we want. The answer over there is what we want. Okay, so where we get the sales mix is going to be as follows. So we add in the number of units. Okay, so sales units, goggles 120, visors 180. So goggles 120, visors 180. Okay, that will equal to the 300 as you saw in the scenario, but let's just add it up. So there we go. Okay. So the way we're going to get the sales mix, we're going to say 120 divided by total sales, And over here, we're going to say 180 divided by total sales. So this is our sales mix. Now we can just plug that in. 0.4, 40%, 0.6, 60%. Okay, so we will say the weighted contribution is 62 times 40% and 31 times 60%. Okay, check something quickly. So 125. Okay, raw materials and accessories per shield. Okay, looks like we are sorted. Okay, now we add up the two. So the weighted contribution is 43 Rand 44. Okay, so the weighted contribution is 43 Rand 44. Okay, so 43 Rand 44. We're going to say equal that divided by 43 Rand 44. So the weighted contribution is 96,682. Okay, so that is, but this year is total units, both products. We only want the margin of safety for visors. Okay, so just take note of that. Now we must split this up. Okay, so now we need to split that up, which is going to be goggles, visors. Okay, you can just do visors because you only need visors. I'm just doing both. Okay, so you can see a completed picture. You can only do, in this question, you just need to do visors, but I'm going to do both. So remember, goggles is 0.4, visors is, so this is 0.4, and visors is 0.6. So we will say that multiplied by 0.4, that multiplied by 0.6. Okay, so you just needed to do 0.6 because we don't need goggles. So there we go. But the answer over here, you can't have 0.75 of a visor. So it is 58,010. This one here is 38,674. Okay, because you can't have 0.17. So therefore, that number we will plug in. So we go break-even units for visors is 58. Okay. So break-even, margin of safety, budgeted sales. So margin of safety equals budget of sales minus break-even units divided by budgeted sales. So you convert this into percentage, it is 66.77. Okay, so that is basically how you do it. So what's important over here to take note is that, what did we do? I started with the end in mind. What do we want? And then from there, we work backwards. We go all the way down till we need all the nitty-gritties. So that's how I identified we have budgeted sales, but then I needed break even. Then I'm like, okay, I need to calculate break even. So what is break even? Fixed cost divided by contribution margin per unit. But I know we don't use contribution margin, we use a weighted contribution margin. We use a weighted contribution margin when there's more than one product. So then I needed to calculate fixed cost and I needed to calculate weighted contribution. So this is where all the marks is lying, mainly in the weighted contribution calculation. Okay, so that's basically it from my side for this question. Let's just see. So that was part B. As you're not going to cover, that is general knowledge. You can read through that. We did part C. So they just say, critically discuss if the Shields department should treat the recycled sheets as a joint or a byproduct. So remember, what makes something a joint product? What makes something a byproduct? So firstly, is it, this concept come through, we put in one material, that polycarbonate, and then we get three products. We got a shield, we got goggles, and we got what did we get? We got recycled sheets. Now the question is the recycled sheets is the recycled sheets a joint product or a byproduct? The way you test this is work out the sales value of the recycled sheets, and you compare it to the sales value of the goggles and the visors. So a byproduct is a sales value that is insignificant, that is very small relative to the other products. Okay, so that's basically how you'll go about doing it. So you can read through that one, and then this is a auditing question, so you can read through this from an auditing perspective. Okay, so that's it from my side for this particular question. Okay, thank you very much, and I'll see you on the other side.